Here in my hand is the oldest known book detailing how stock market investing worked almost 400 years ago. Obviously, this is a copy and only a few originals are left in the world. Anyway, I wanted to share with you some of the lessons from the book as I was completely shocked by just how relevant they are to what we face today. And I think you can become a more successful investor if you listen to some of the advice from this book and avoid some of the traps which are still happening to this day. Now, the title of this book translates to mean Confusion of Confusions. It was written by a man called Joseph de la Vega in 1688, who was born in 1650. Now, Joseph's family had fled to Holland when he was young, and he would grow up and remain in Amsterdam for his whole life. This book describes in great detail all of the goings-on in the Amsterdam Stock Exchange, which at the time was the largest market of its kind. Think of how the New York Stock Exchange looks today, trading trillions of dollars worth of stocks. Amsterdam was the equivalent back in the 17th century, but it obviously looked very different. Everything was carried out in person with no technology, and the dealing was done face-to-face all over the exchange itself, in the open and even outside of the exchange in the coffee houses. Yes, even back then, people loved to grab a coffee and pretend they were working even without the free Wi-Fi. Now, the choices of investments weren't quite the same as today. There weren't thousands of different shares you could buy or any kind of mutual funds or ETFs. The Amsterdam Stock Exchange was created to sell shares of a single company, the Dutch East India Company. Now, you may have heard of this if you're a bit of a history nerd, but this company was hugely successful. They travelled the seas acquiring various spices and other exotic goods, and their journey was often extremely perilous. Now, according to the history books, of the first 65 ships that set on their journey, 10% would sink and never return. And even those that returned would lose 2/3 of their crew. This was risky business and expensive as well, which is why they needed to raise a lot of money. What better way to raise money than to create shares that you can sell to lots of different people, and in return, those people can benefit from the riches based on how many shares they have. Welcome to the Amsterdam stock market, where riches and fortunes were made. Anyway, what could we possibly learn about investing today from a stock market from 4 centuries ago? You will not believe just how similar things were. Now, the title of this book should give you a bit of a clue as to where this first lesson is going. It's called Confusion of Confusions, and Joseph compared the market to a labyrinth. He said that everything was going on at once. Every rational action was matched with an irrational one, and every kind of trick that was played between the brokers was played back at them. There were so many moving parts and so many things happening at once, and there was no way to make sense of what was really happening. Now, even though it was confusing and there were lots of moving parts making predictions impossible, there were still plenty of people who claimed to know the future. Let me quote you here what he has to say. Many people make themselves ridiculous because some speculators are guided by dreams, others by prophecies, these by illusions, those by moods, and innumerable men by chimeras. He goes on to add that people who get involved in this swindle seem to resemble the English Quakers, who believe to contain in their bodies an inner light that advises them. These stock exchange people are quite silly, full of instability, insanity, pride, and foolishness. They will sell without knowing the motive, they will buy without reason, they will find what is right, and will err without merit or fault of their own. Now tell me that this exact statement could be written about the stock market today, 400 years later, and we still have the same false prophets, the people who claim to know the future and those who make up any kind of reason to justify their behaviour in the stock market. If anything, it's made even worse now with the use of social media and the internet. No longer are crazy reasons kept to a small corner of the stock market between 1 or 2 people. Now they have a platform to reach millions of people. I'll leave that to you to decide who those people are you see on TV and here on YouTube that behave in that exact same way as people did hundreds of years ago.
Should I be worried about Bear Stearns in terms of liquidity and get my money out of there? No, no, no.
Anyway, the lesson here is to ignore all of these people. Nobody knows anything about the future, but it won't ever stop people pretending that they do. This next lesson is timeless, and it's so funny reading this today. Joseph talks about the history of the East India Company's shares over the long run, and describes how well they've done from all of their gains and dividends paid. He says this: from the founding of the company to the date of this conversation, the dividends have amounted to 1,482%, while the value of the capital has increased more than 5-fold. This treasure is compared to a tree because it yields fruits almost every year, and although during some years it's only produced blossoms, there have been other years when it's resembled the trees of Aruba, which display their fruitfulness 2 or 3 times a year. Now, just compare this to the modern day for a second. What he's saying here is that most people would have been far better off buying and holding their investment rather than trying to speculate all the time. This is so funny to me because we know that still to this day, the average investor still performs below even the long-term average of the stock market. I always like this bit of data from JP Morgan showing the average performance returns of retail investors compared to other types of investments. The average retail investor lags so far behind, it's scary, and this is mostly down to the fact that these investors are speculating wildly. They're doing the exact opposite of what they need to do, and their performance is suffering because of it. Even with all of the technology we have now and all of the knowledge at our fingertips, it is still crazy to think that this hasn't changed for hundreds of years, and it may never change. Let me also share another little story from the book here to highlight this point. Joseph describes the stock market operators in three main categories. He calls them the princes, the merchants, and the speculators. The princes, he says, are those people who enjoy the dividends, sit back and don't care about the price of the shares. I quote, "They do not care about the movements in the price of the stock, since their interest lies not in the sale of the stock, but in the revenue secured through the dividend. The higher value of the shares forms only an imaginary enjoyment for them, arising from the reflection that they could in truth obtain a high price if they were to sell their shares." He then describes the merchants, big buyers who make trades but are only looking to trade based on small bits of news, and they seek to get a small slice of the profit, usually in quite a secure way. I think these are almost like the market makers of today. They find a way to make money no matter which way the market goes, so long as people keep buying and selling. Now, the final category he describes are the speculators, and he has quite a very low opinion of them, saying gamblers and speculators belong in the third class. They have tried to decide all by themselves about the magnitude of their gains. In order to do so, they've put up wheels of fortune. Oh, what double dealers. Oh, what an order of life has been created by these schemers. The labyrinth of Crete was no more complicated than the labyrinth of their plans. In short, try and be more like the princes and less like the speculators. You'll probably do a lot better. There's so many great stories in this book that are relevant today, and this point could not be highlighted enough. You are your own worst enemy when it comes to investing because you have to control your urges and resist making stupid decisions, even when faced with the endless barrage of information. Even back in the 17th century, investors tried to make the sense of the most recent news and speculate on what might happen to the value of their shares. Listen to this part. There are three causes of a rise in prices on the exchange and three of a fall: the conditions in India, European politics, and the opinion of the stock exchange itself. For this last reason, the news is often of little value, since the counteracting forces may operate in the opposite direction. He then talks about getting hold of the latest news about how a ship is doing or conditions of their cargo. And then he adds this: even if one possesses such information, it will not be reasonable to speculate wildly in blind trust. For if the speculator undertakes more than his financial strength allows and scorns Seneca's advice that the table should not be larger than the stomach, it is inevitable that he fall over with the burden and that the world slips from his shoulders, for he is no Atlas. This next bit is key for me. The book reads, even if we assume that the news is good and correct, that the reports come at the right time, and that they announce a happy arrival of the ships, nevertheless, an untoward event occurring subsequent to the acquisition of the news may destroy the splendour and contentment. For ships can sink inside the harbour and hopes be thwarted. That last bit is key for me here, and it just reminds us that there is no way of knowing the future, and whether good news means the share price should rise or whether it should fall. There are just so many modern examples of this by people taking information and the latest news and making up their narratives to suit their worldview. For example, assuming that Nokia would remain the most powerful mobile phone company in the world because it had grown so much and had the largest market share, or predicting the movement of the market and suggesting that a recession must be coming because of one of the set of poor jobs reports. Remember just a few weeks ago now when the market had a bit of a flash crash and huge amounts of people sold out as a narrative was all about the recession. The market went from being bullish to being completely scared in just a matter of a few hours. And everyone jumped on board screaming that this was it and there was going to be a huge decline in prices. Just a week later and things had recovered and we've totally forgotten about it. The lesson here, if you are a long-term investor, the news should not concern you one bit. There will always be plenty of reasons to sell, and there always has been. If anything, now with modern news and social media, there are even more reasons coming out every day suggesting that they can somehow predict the future. For me, come back to this story and just do nothing. On that note, if you do want to join my investing community or get yourself set up with an investing account, I do leave everything in the description below. You can get yourself some free offers if you're a new customer. Just remember to ignore the news. I've changed a famous saying here that says pessimists sound smart, but optimists make money, because that is pretty much exactly what Joseph writes in his text. He describes the stock market as a constant battle between the bulls and the bears. On the one side, you have people who are fully optimistic and see only good things ahead. And then on the other hand, you have the bears who will focus on any bit of bad news and try to spread that around the market to prove their point. He writes the following as a bit of a story. Eutychus tells that in Hestiotis, there were two wells called Ceron and Milan, and that if the sheep drank from the first, they became white, and if they drank from the second, they became black. If they drank from both together, they became different colours, as interesting as agreeable to the eye. If you wish to succeed in your enterprises, don't drink continually of the well of the bulls, because it's no good to be white, but do not drink from the well of the bears either, for it's never good to be as black as a raven. In short, not always Milan and not always Ceron, but always speculate for a rise from natural inclination and on a fall only on occasion, because experience has shown that usually the bulls are victorious and the bears lose out. It's funny reading those words today, as this story has played out time and time again. Yes, stock market crashes happen, recessions happen, and there can be years when shares are down in the dumps. This is all part of being an investor. However, just because the stock market can crash or pull back, that's not to say that it will always keep doing this frequently. As we look back through history, we know that there's been more bull markets than bear markets, and the market has moved higher during the bull markets than it gets drawn down during the bear markets. What's funny is that we all know how crazy the stock market can get during those bear markets, as so many people keep saying it's set to go lower and it's time to sell out. Yet time and time again, the market proves itself to be resilient. The reason I like to remind myself about this is that when we invest, we aren't just betting on some kind of magical money tree. We're buying real businesses that make real profits, and over time, we've seen companies get way more profitable, especially as new technology allows them to scale like never before. So anyway, the lesson here is not to get too excited, but then also don't let yourself get convinced that that's the end of the world either. In the book, there are quite a few good stories about how people in the stock exchange played all kinds of dirty tricks to get one up on each other. And it reminded me that everyone in the market is playing completely different games. Some people are in this for the short term, some for the long term, and everything else in between, including those who have no idea what they're doing at all. One of the games that were played went like this. Joseph writes, a broker in whom the syndicate has confidence is given the order to buy secretly a batch of shares from an avowed bull without revealing his real principal. But he sells the very same shares with a good deal of publicity, while it's shouted out that even the bulls are making sales. As the broker wants to sell to one bull the same shares he has bought from another bull, the first one sees that the story about the sales of the latter is true. Alarmed, the second bull sells his share also. Seized by fear, everybody tries to forestall the sales of the others and regards any advice to buy as deceitful. Such a panic we call to be in the tortures. Again, I can think of so many examples with people playing tricks on each other and trying to get the one up on the market. Whether it's people who go on TV to pump their own stock, or people claim to want to sell something in order to get a cheaper price. So many games are being played, and none of them are all anything new. They've all been going on for hundreds of years, just repeating themselves over and over again. Now, your job as an investor is to make sure that you know what game you're playing and to stick with that game rather than get sucked into all the other games. In the book, there's also so much talk about trading options and even fake shares of companies by people on street corners, looking for any way to make a quick buck and some fast money. Yet again, just another reminder that human nature hasn't changed at all one bit, and there'll always be enough people out there to be taken for mugs and happy to speculate, even if their odds of making any money are extremely poor. Anyway, thanks for watching. Happy investing.